Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Well, I just came back from San Antonio, Texas, where I was at the IPI conference. This is a great situation that they do every year. And that IPI conference brings together all of the brokers that they have in bank branches from across the country, as well as CEOs and CFOs and senior management team members who come down to listen to speakers, of which I was fortunate to be one of them. And what's interesting is that Jamie Sumner, our Director of Analytics at Seafried and Brew, also came down, and one of the things that he brought about was a trend slide that I think is very important, because you've heard me talk about the top 15th percentile banks out there, that they have a high level of return, but at the same time they have a low to moderate level of risk. And that is traditional conservative community banking. And what I asked Jamie to do was to look at net charge-offs in here, because I think a net charge-off historical chart is very important to look at. So the dotted red line in here is the national benchmark of community banks. At the same time, the top 15th percentile banks is the blue line. And of course, you've heard me say before, we've had over time a level of non-performing assets in any kind of credit cycle. The question is that did your bank get affected more or less than the national average? And so we look at this moderate to low level of risk that the top 15th percentile banks have taken, and you can see that it has paid off in terms of having a much lower level of net charge-offs, where essentially you can say that's where the rubber meets the road in terms of credit management. So when we think about that, is that can we operate our banks with a lower level of risk and at the same time have a high level of return? And the top 15th percentile banks have shown this over and over again. Then I spoke at the conference and I talked about municipal bond due diligence. And I brought up some new things around the Seafried and Brew municipal bond ratings that we're doing now. But let's go back to the basis of where the regulators are coming from, as well as what I believe the due diligence is needed to look at a municipal or even a corporate credit. So the two questions must be answered before a bank can purchase a municipal bond. Is the price of the security consistent with other like securities? So what we do at Seafried and Brew is that we give a curve, and in this particular case, is the little black dot is where the security is priced, which would suggest that that price is consistent with other markets. Then the next question is the security investment grade. And from that standpoint, we all know that now we cannot base our investment grade on the major rating agencies. But as we know, Seafried and Brew provides independent third-party municipal and corporate bond ratings for our clients. And we have had no criticism from the OCC, FDIC, or the Fed in terms of our ratings, because it really comes down to methodology. And we feel our methodology is sound, looking at, one, financial strength and also demographic strength. So what do we do when we look at that financial strength? Is that we have so many inputs that we use here, depending on the particular issuer, and looking at it from the standpoint of where we see trends in the financials, etc., over time. To develop our ratings, this is a sample of one of our rating reports where we look at strengths and weaknesses, is that we then rate the bond, in this case our highest rating, Seafried and Brew, 1 rating, and we designate this bond to be investment grade. So then we look at it from the standpoint of demographic, and this is a key piece that we've added into our overall ratings, to look at the demographics from the standpoint of more a national type average for each individual county in the nation. And in this particular case, you'll see green, which indicates above average, that pinkish, which is below average, and then average. And then we come up for an overall economic score, in this case, average for that particular municipality. The other piece that we do is that we also develop for the post-purchase and pre-purchase, is to look at it not just state-based. So when we look at diversification, we recommend to our banks to really look at it based upon economic zones around the country. Because, say, and we look at, we're from Pennsylvania, that there's multiple economic zones within the state of Pennsylvania. We have the Marcellus Shale area. We have the area that we live in, the Lehigh Valley. You have Philadelphia. All of these are different economic zones that, depending on what happens to the national and state economy, can have different impacts depending on that zone. So we recommend, for instance, that banks only put, in terms of diversification, 15% of Tier 1 leverage into one particular zone in the country, and to have that in your policy. So when you look at your policy, that essentially there's key items in that policy from the standpoint of using the Seafried and Brew ratings, the diversification, the post-purchase and pre-purchase analysis that's required to give yourself municipal bond due diligence. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.